7 words, that is all it took to send global financial markets into complete chaos this afternoon. These were not words of a politician looking for a soundbite or a corporate CEO trying to boost a stock price. They were spoken by a man who has spent his entire career inside the most powerful central banks on the planet. This individual knows the global financial system better than almost anyone alive. He understands exactly how the plumbing of the world economy works, and more importantly, he knew exactly which pressure point to hit to cause the maximum amount of damage to the United States economy. When he spoke those 7 words, he wasn't just making an announcement, he was pulling a trigger on a financial weapon that had been loaded and aimed for weeks. As a reporter, I have been on the front lines of some of the biggest financial disasters in modern history. I have stood on the floor of stock exchanges during market crashes where billions of dollars evaporated in seconds. I have reported from countries where the local currency collapsed overnight, leaving families unable to buy basic groceries. I have covered intense economic confrontations between rival nations that threatened to spill over into real-world conflict. But I can tell you truthfully that I have never seen anything like what unfolded today. This is not a conflict between traditional enemies. This is a total breakdown between 2 countries that have been the closest of allies for over a century. They share the longest undefended border in the world, and their economies are so deeply linked that it is often hard to tell where one ends and the other begins. The speed at which this situation transformed is what makes it so terrifying. This began as a localized dispute over energy policy, the kind of disagreement that usually gets settled behind closed doors by diplomats and energy ministers. But instead of a quiet resolution, it has escalated into a full-scale financial war. This is no longer just about oil or gas pipelines. This is about the fundamental structure of how money moves around the globe. The actions taken today have the potential to permanently reshape the international financial order. We are moving away from a world where everyone trusted the same system and toward a future where that trust has been completely shattered. The most remarkable part of this entire crisis is how it caught the world completely off guard. Most analysts, traders, and government officials were going about their Tuesday as if it were any other day. They assumed that even if things got tense, cooler heads would prevail, because the cost of a fallout was too high for both sides. Almost nobody saw this coming. However, as the details emerge, it is becoming clear that one man was not surprised at all. He had been quietly and methodically preparing for this exact moment for weeks. While the rest of the world was looking the other way, he was lining up his defenses and readying a counterstrike that would stun Washington and send shockwaves through every trading floor from New York to Tokyo. This afternoon, the world witnessed a move that was completely unprecedented in modern history. The United States government decided to deploy its most powerful economic weapon, but they didn't aim it at an enemy or a rogue state. Instead, they aimed it directly at Canada. This is a country that is a NATO ally, a core member of the Five Eyes intelligence-sharing partnership, and historically America's single largest trading partner. To see the US use this level of financial force against its closest neighbor is something most experts thought was impossible. It represents a total breakdown of a century-old relationship, shifting from cooperation to open economic hostility in a matter of hours. The attack officially began at 3:12 p.m. Eastern Standard Time. That was the moment the White House released a signed executive order that imposed immediate and severe financial restrictions on every major Canadian banking institution operating within the United States. This wasn't just a warning or a list of future fines. The order is a kill switch for the way these banks do business. It effectively freezes all correspondent banking relationships between the 6 largest Canadian banks and their American counterparts. Because most global money transfers rely on these connections to move funds, this order essentially cuts Canadian banks off from the heart of the global financial system. This order is scheduled to take full effect at midnight tonight, leaving almost no time for businesses or individuals to prepare. The White House has tried to justify this aggressive move by calling it a necessary measure to protect American financial sovereignty. The administration claims that Canada's recent refusal to guarantee specific energy exports created an unacceptable national security risk for the United States. They are arguing that if Canada won't promise to send the energy America needs, then the US has no choice but to respond with the most persuasive tool in its shed, the US dollar. By calling energy a matter of national security, the president has given himself the legal cover to treat a peaceful ally like a hostile threat. The logic behind Washington's plan was cold and calculated. The US government knows that Canada's economy is not just linked to the United States, it is practically fused with it. Canadian banks process hundreds of billions of dollars in US currency every single month to facilitate trade, pay for goods, and manage investments. Washington's calculation was simple. Because Canada is so deeply integrated into the American dollar system, cutting off that access would cause an immediate and total paralysis of the Canadian economy. They believed that by shutting down the ability of Canadian banks to move money, they would create such intense panic and economic pain that the Canadian government would be forced to surrender. The planners in the Oval Office actually believed this move would bring Canada to its knees within 48 hours. They expected the Canadian Prime Minister to be on the phone by tomorrow morning, begging for a deal and agreeing to every American energy demand just to get the banks turned back on. They viewed the US dollar not just as money, but as a leash that they could pull whenever an ally didn't follow orders. They were betting everything on the idea that Canada had no other options and no way to fight back against the sheer size and power of the American financial system. They assumed the first strike would be the only strike needed to end the dispute on American terms. The United States government made a massive mistake in their calculations because they failed to understand exactly who they were picking a fight with. They assumed they were dealing with a typical politician who would panic once the banks were frozen. But Canada is currently led by Mark Carney. This is a man who didn't just study economics. He ran the central banks of 2 different G7 nations. He managed the Bank of Canada through the 2008 global financial crisis, and then moved to the United Kingdom to run the Bank of England during the chaos of Brexit. He is widely considered one of the most skilled financial crisis managers in the world. When Washington pulled the trigger on its economic weapon, Carney didn't call the White House to beg for mercy. Instead, he walked into a press conference in Ottawa at 5:08 p.m. How the day adjusted his glasses and prepared to launch a counterstrike that the US never saw coming. Carney stood at the podium and looked directly into the camera lens to speak to the world. He didn't use complicated language or hide behind political jargon. He spoke 7 simple words that instantly changed the course of history. Canada will now sell its US Treasury holdings. To most people, that might sound like a boring accounting move, but in the world of high finance, those words are the equivalent of a nuclear launch. By making this announcement, Canada officially threatened to dump over $319 billion worth of American debt onto the open market. This is the ultimate red button in global economics. The United States survives by borrowing trillions of dollars from other countries, and Canada is one of the biggest lenders. By deciding to sell all of that debt at once, Canada is effectively trying to crash the value of the American dollar and send US interest rates through the roof. This move is the most dangerous financial escalation between 2 allied nations since the end of the Second World War. For decades, there has been an unspoken rule in global politics. You never weaponize a friend's debt. The United States relies on its allies to buy and hold its treasury bonds, because that stability allows the US to keep its economy running and its interest rates low. Washington always assumed that even if there was a disagreement over trade or energy, an ally like Canada would never dream of touching the bond market. They thought the debt was a safe zone. Mark Carney proved them wrong in a single sentence. He realized that if the US was willing to break the rules by freezing Canadian bank accounts, then Canada was no longer obligated to help prop up the American economy by holding its debt. By targeting the US Treasury market, Carney hit the most vulnerable spot in the entire American financial system. When a country as large as Canada dumps $319 billion in bonds, it creates a massive oversupply. When there is too much of something for sale and not enough buyers, the price collapses. As the price of those bonds falls, the interest rate or yield on that debt automatically spikes. This means that every single person in the United States is about to feel the pain. High Treasury yields lead directly to higher mortgage rates, more expensive car loans, and higher costs for businesses to operate. Carney didn't just attack the US government, he launched a strike that hits the wallet of every American citizen. This was not a desperate or emotional reaction, it was a cold, professional execution of a financial plan. Carney understood that the US dollar only has power as long as people trust the system. By announcing this massive sell-off, he signaled to every other country in the world, from Japan to China to those in Europe, that the US Treasury market is no longer a safe place to keep their money. He effectively told the world that if the US can turn on its best friend, it can turn on anyone, so everyone should start selling their American debt before it's too late. It was a masterclass in financial warfare, turning the United States' own debt into a weapon that could destroy its economic stability from the inside out. The reaction to Mark Carney's announcement was instantaneous and severe, triggering a level of panic that modern financial markets are simply not equipped to handle. Within just 20 minutes of those 7 words being spoken, the US dollar index, which measures the value of the American dollar against other major world currencies, dropped by a staggering 3.1%. To put that in perspective, this is the largest single-session decline the dollar has seen in over a decade. In the world of high finance, a currency usually moves by fractions of a percent in a day. A 3% drop in 20 minutes is a total collapse of confidence. Traders around the globe realized that if Canada was dumping its US debt, the dollar was no longer the safe asset everyone thought it was, and they began selling off their own holdings as fast as possible to avoid being the last ones holding a devaluing currency. At the same time, the bond market went into an absolute tailspin. The yield on the 10-year US Treasury note, which is the most important interest rate in the global economy, spiked from 4.38% to 4.91% in a matter of minutes. This happened because of a basic rule of supply and demand. When Canada announced it would flood the market with $319 billion worth of bonds, the supply became overwhelming. When there is too much of something for sale, its price crashes. In the bond market, when the price of a bond goes down, the interest rate, the yield, goes up. Investors panicked because they knew that if $319 billion in bonds hit the market all at once, there wouldn't be enough buyers to soak them up, forcing interest rates to skyrocket just to attract new investors. For ordinary Americans, these numbers are not just abstract statistics on a screen. They translate directly into real-world costs that will hit their bank accounts immediately. The interest rates for things like mortgages and car loans are tied directly to these 10-year Treasury yields. Because those yields spiked so aggressively today, experts are projecting a full percentage point increase in mortgage rates within just a few days. For an average American family already struggling with high inflation and the cost of living, this is a financial catastrophe. A 1% jump in a mortgage rate can increase a monthly house payment by roughly $340 overnight. This is money that families usually spend on groceries, gas, or education, and it is now being sucked away simply because of a diplomatic war between 2 governments. The chaos didn't stop at the banks or the bond markets. As investors watched the US dollar lose value and interest rates climb, they became desperate for a safe haven somewhere to put their money, where it wouldn't be destroyed by the falling dollar. This led to a massive historical surge in the price of gold. Gold jumped $127 per ounce in a single afternoon, hitting an all-time high. This type of move only happens when the world's biggest investors believe the traditional financial system is failing. They aren't buying gold because they want to make a profit. They are buying it because they are terrified that the US financial system is no longer stable enough to protect their wealth. Finally, the stock market reflected the sheer gravity of the situation. Major US bank stocks began to collapse almost immediately after Carney finished speaking, with shares of the largest American financial institutions dropping between 8% and 11%. Investors are pricing in the very real risk that a full-scale financial war between the US and Canada will break the global banking system. If Canadian banks can't move money and the US government is facing a debt crisis, the entire engine of the American economy grinds to a halt. Every trading floor from New York to Tokyo is currently in crisis mode, with phones ringing off the hook as central bankers try to figure out if there is any way to stop the bleeding before the markets open tomorrow morning. What makes Mark Carney's strategy so sophisticated is that he didn't just launch a devastating attack. He built a massive, impenetrable shield to protect Canada's economy from the very weapon the United States tried to use. While Washington thought they could paralyze Canada by cutting off its access to the US dollar, Carney revealed that he had already activated emergency swap lines with the world's most powerful central banks. He announced that the Bank of Canada is now working directly with the European Central Bank, the Bank of Japan, the Bank of England, and the People's Bank of China. These are not just symbolic agreements, they are the literal plumbing of the global financial system. By activating these lines, Carney ensured that Canadian banks don't need a single American dollar to keep the country's economy running. To understand why this is so important, you have to understand how global trade usually works. Normally, if a Canadian company wants to buy something from Europe or Asia, they almost always use the US dollar as a middleman. The US dollar is the bridge that connects different currencies. By cutting off Canada's access to that bridge, the White House expected all of Canada's international trade to stop dead in its tracks. But Carney's shield changes everything. These swap line agreements allow Canadian banks to trade directly in euros, yen, British pounds, and Chinese yuan. It effectively creates a bypass around the United States. It means that a Canadian business can pay a supplier in France using euros or a factory in Japan using yen without ever touching the American financial system. This move effectively neutralized the primary weapon the United States had deployed. The US thought they were holding the only keys to the global economy, but Carney showed them that Canada has its own set of keys. By the time the White House pulled the plug at midnight, the liquidity Canada needed, the actual cash required to settle trades and keep businesses afloat, was already flowing in from London, Frankfurt, Tokyo, and Beijing. Canadian commerce didn't stop, it just pivoted. The United States tried to isolate Canada, but instead, they found themselves being the ones left out of the equation. Canada is now operating in a new financial reality, where the US dollar is no longer a requirement for survival. The most shocking part of this announcement is the timing. These massive, complex financial arrangements cannot be set up in a single afternoon. They require weeks of intense negotiation, legal drafting, and technical coordination between the world's most powerful central bankers. This means that while the White House was busy drafting its executive order to attack Canada, Mark Carney was already 10 steps ahead. He saw the storm coming long before the first strike was even launched. He spent weeks quietly pre-positioning Canada's defenses, making sure the shield was ready to be activated the second it was needed. This wasn't a panicked response. It was a trap that was set long ago. By activating these swap lines, Carney has also sent a message to the rest of the world that will haunt Washington for years. He has proven that the US dollar is no longer the only game in town. For decades, the US has used its control over the dollar to force other countries to follow its rules. But today, a major Western ally showed that it is possible to survive and even thrive by simply walking away from the dollar system. Every other country that is currently worried about American financial pressure is watching Canada right now and taking notes. Carney didn't just save Canada's economy today, he provided a blueprint for how the rest of the world can eventually break free from American financial dominance forever. Beyond the high-level financial warfare being waged in the halls of central banks, a deeply personal and immediate humanitarian problem is exploding on American soil. We are not talking about stocks or bond yields anymore. We are talking about the basic ability of millions of ordinary citizens to function in their daily lives. One major Canadian bank alone operates over 1,000 branches spread across 15 American states, primarily along the East Coast. These branches are not just corporate offices, they are the financial homes for millions of Americans who have trusted this institution with their paychecks, their savings, and their livelihood. Collectively, these branches hold approximately $380 billion in deposits from American customers. As of midnight tonight, due to the executive order, these millions of people are effectively locked out of their own money. The reality of this situation is difficult to comprehend for those who haven't experienced it. Imagine waking up tomorrow morning in New York, Florida, or Connecticut to find that your bank card is suddenly declined at the grocery store. You try to log into your online banking portal to pay your monthly mortgage, but your access is blocked. You go to the local branch hoping to withdraw cash to cover your rent, only to find the doors locked and a notice on the glass explaining that the bank has been cut off from the US financial system. For a family living paycheck to paycheck, this is not a political debate. It is an instant catastrophic loss of survival resources. They cannot make payments, settle bills, or access the very cash they need to keep their household running. This situation has left the Federal Deposit Insurance Corporation, FDIC, in a state of absolute scramble. The FDIC exists to protect depositors if a bank fails or becomes insolvent, but the banks being targeted here are not insolvent, they are solvent and healthy. They have been forcibly disconnected by a government order. This creates a massive legal and technical grey area. The FDIC is currently struggling to determine whether these US-based operations fall under their standard deposit insurance protections, given that this isn't a typical bank run or a business failure. Legal experts are calling this uncharted territory because there is no clear precedent for a president using emergency powers to effectively freeze the personal assets of millions of innocent, law-abiding US citizens over a foreign policy disagreement with a neighbor. The political fallout is already beginning to boil over. State attorneys general from the affected states have launched immediate reviews into the legality of this executive order. They are arguing that their constituents are being held hostage as collateral damage in a trade dispute. You have millions of people who have done nothing wrong. They haven't violated any laws. They aren't part of any international conflict. And they have no say in energy policy, yet their ability to pay for food, housing, and electricity has been severed. The anger among these constituents is mounting, and elected officials are issuing furious statements, demanding that the administration address the humanitarian impact of these sanctions before this localized financial freeze turns into a broader social crisis. This is no longer just a confrontation between Washington and Ottawa. It is a confrontation between the government and the American people whose daily lives have been disrupted by this unprecedented use of executive power. The most lasting and potentially most destructive consequence of today's events is the death of trust. For decades, the entire global financial order has rested on a single critical assumption that the United States, as the steward of the world's primary reserve currency, would not arbitrarily weaponize access to that system against countries that play by the rules. International trade and global banking have operated under the belief that the US dollar is a neutral platform, a safe haven where countries can store their wealth and settle their debts without the fear that Washington might suddenly turn off the lights. By treating a treaty ally like Canada, a nation that has faithfully followed international norms, the same way it treats adversaries like North Korea or Iran, the United States has shattered that foundation of trust in a single irreversible move. Tonight, central bank governors and financial ministers all over the world are staring at their screens, asking themselves the exact question Mark Carney predicted. If they did this to Canada, what stops them from doing it to us? This is the moment the global financial system fundamentally changes. When countries hold reserves in US dollars, they are essentially lending their wealth to the American government in exchange for safety and stability. If that safety is no longer guaranteed, the motivation for holding those dollars vanishes. We are now seeing the start of a massive global re-evaluation of risk. Nations that have been loyal partners for years are realizing that their own economic survival can be threatened at a moment's notice, and they are beginning to look for exits. If the world begins to actively diversify away from the dollar, moving reserves into gold, euros, yen, or other assets, the impact on the American economy will be immediate and generational. Currently, the US government is able to borrow nearly $2 trillion every year at relatively low costs precisely because there is insatiable global demand for US Treasury securities. That demand is the lifeblood of the American deficit. If that demand dries up because central banks no longer trust the dollar as a safe asset, the United States will be forced to raise interest rates significantly just to attract buyers for its debt. This would not just make financing the national deficit impossible, it would drive up the cost of every single loan in the US, from corporate expansion projects to the debt burden of the federal government itself. This could mark the end of what economists call American financial hegemony, the unique privilege the US has enjoyed for 80 years of borrowing cheaply, printing the world's money, and projecting power through financial leverage. Hegemony is not guaranteed by military force or economic size alone. It is guaranteed by the global belief that the system is fair and reliable. When a hegemon acts arbitrarily, it invites the rest of the world to build a new system that doesn't rely on it. We are likely witnessing the beginning of a slow, irreversible migration to a multipolar financial world. The dollar will remain a major currency for a long time, but its absolute monopoly is breaking, and the era of the United States effortlessly financing its ambitions at the world's expense is coming to a close. We are now looking at 3 distinct potential scenarios for how this unprecedented financial war could unfold. These paths are not just speculative, they represent the real-world choices now facing leadership in both Washington and Ottawa, and each carries different but severe consequences for the global economy. The first scenario, rapid de-escalation. In the first and most immediate scenario, political pressure forces a quick reversal. As millions of innocent Americans across at least 15 states wake up to frozen bank accounts, the domestic backlash in the United States will be swift and intense. Governors, state attorneys general, and members of Congress will face overwhelming pressure from their constituents who cannot access their money to pay rent, buy groceries, or cover medical bills. If the White House realizes that the political cost of this humanitarian crisis on American soil outweighs the perceived strategic gain of the energy dispute, They may be forced to rescind the executive order within 48 hours. In this scenario, Canada would likely pause its Treasury sales, but the damage would already be permanent. Canada now has a proven, independent financial infrastructure, and other nations around the world have witnessed that the US is willing to use its financial system as a weapon against allies. Trust, once shattered, cannot be easily rebuilt, and the slow process of global diversification away from the dollar would likely continue in the background, even if the immediate crisis ends. The second scenario, prolonged financial conflict. The second scenario is a long, grinding war of attrition. If the president refuses to back down, the conflict enters a dangerous phase where Canada begins to methodically sell off its US Treasury holdings in large, planned tranches, perhaps $30 billion every week. This consistent selling pressure would push the 10-year Treasury yield significantly higher, potentially crossing 5.5% within a month. As yields climb, mortgage rates would likely move past 8.5%, effectively freezing the US housing market and crashing corporate valuations. Facing an existential threat to the stability of the bond market, the Federal Reserve would be forced to intervene as the buyer of last resort, essentially printing new money to purchase the bonds that Canada is selling. This move would trigger a massive spike in domestic inflation, as the increased money supply debases the value of the dollar. In this scenario, the United States trades its financial stability for the cost of maintaining the conflict, turning a geopolitical dispute into a long-term domestic economic crisis. The third scenario, the slow migration to multipolarity. The final and most transformative scenario is the slow migration where Canada's newly activated swap line network becomes a permanent fixture of global finance. If Canada's banks prove they can function without the US dollar, and if other resource-exporting nations observe this success, we could see a fundamental change in how global trade is settled. Nations might begin to negotiate trade deals in euros, yuan, or yen, permanently reducing the world's reliance on the dollar. Over the next 18 months, the share of global trade settled in US dollars could drop significantly. In this world, the dollar remains a major global player, but loses its absolute, unchallenged dominance. US borrowing costs would increase permanently, because the world no longer treats treasuries as the only safe asset. This would not end with a sudden spectacular crash, but rather with a slow, irreversible migration to a multipolar financial system. The era of unchallenged American financial hegemony, an era that defined the post-war world, would effectively come to an end, replaced by a more fragmented and unpredictable global order. The trust is broken, the global financial community is alarmed, and the world is watching,